Ladies and gentlemen, the Singapore government T-bill rates have crashed terribly. And I think the worst is yet to be. So how bad can it go down? So what are the alternatives? What's the impact to the stock market? So today we'll attempt to answer all these important questions. And let's watch on, shall we? These are my usual disclaimers, and let's go. In the latest Singapore one-year T-bill rates that were announced, the rates have crashed to 2.71%. Now, that's a dramatic fall from the 3.38% offered in the previous auction that just closed in July. Now, many people loves the Singapore T-bill rates because it was a guaranteed return by the Singapore government at a very high rates. And Singapore investors generally are very dividend seeking, cash seeking, yield seeking. And this is a terrible news to many Singapore investors. And I certainly think that we should analyze this in deeper detail. So this is a very significant event. And let's watch what the analyst is saying about the Singapore T-bill rates. So the Singapore T-bill rates is 0.67 percent points down from the 3.38% offered in the auction of the previous one-year tranche in July. Now, 0.67% fall is much more than the 0.5% cut by the Federal Reserve. And the head of foreign exchange and rates strategy at OCBC actually mentioned this, that these cutoff rates was below expectation. That means they are quite shocked. And the 67 basis points fall is slightly more than the movement in the market rate that would imply. Because I told you, right, the Federal Reserve only cut by 0.5%, and now there's a fall of 0.67%, right? It's very, very significant. Now, many of you are not just investors in the one-year T-bill rates, you are also investors in the 6-month T-bill rates. And what does it mean, right? According to the same analyst from OCBC, she added that the latest one-year results and the recent 6 months cutoff at 3.06% suggests that investors expect the 6 months rate to fall to around 2.32% 6 months later, and this appeared too low to us. So basically, she was actually shocked by this movement. And this implication of the current rates means that the 6-month T-bill rates could fall to as low as 2.32%. That's even below the ordinary account rates of 2.5%. And that's very, very significant. This kind of news come out. You know what about this? This is a self-fulfilling prophecy, right? If you believe that the rates will fall to this, it will fall to this. You know why? Because these rates is depend on the bidders. So the more people bid low because they believe it will go down, it will go down. So T-bill rates is a very accurate rate in the sense that, it is a self-fulfilling prophecy. So how bad can things go? Will what OCBC analysts say come to pass? Well, let's take a look, shall we? The latest T-bill rates was about 3.1%. That's already low. And I think it's important to note that our Singapore T-bill rates is usually lower by the US Fed fund rates by 1 to 2%. And the Fed funds rate expectation, somewhere around 2025, is about 4%. So 1 to 2% down could be as low as 2-ish%. So it's not unthinkable what the OCBC analyst is predicting. The root of all problem is Federal Reserve is going to cut more interest rates. The Euro Central Bank has actually just cut the third round of their interest rates. So it's many, many central banks. The Federal Reserve is probably one of the slowest in the world to cut interest rate. So they've just started with one cut. And I think the market consensus is that they're most likely to cut by another 0.25% and then another 0.25%. And as a result, first of all, people will likely to lowball their next bid in the T-bill rates. And guess what? You will end up just being lower. And people are trying to put money into other places to get higher returns as well. And the SSB, Singapore Savings Bonds, is also coming down to about 2.77%. Okay, so everything is coming down rapidly. So what about fixed deposit rates? So fixed deposit rates are coming down as well, about 2.3-ish% at the lowest. Home loan rates are now very near to the HDB loan rates. And I think as investors, the next thing we should think of is where would investors put their money next, especially those who have put their money into bonds and bills and cash equivalent like fixed deposit or whatsoever to yield those safe high rates. Today, those rates are going to disappear and vaporize. So where would they do, right? Those good times only last as long as the Federal Reserve increased interest rate, and that was about 2 years. So these 2 years of good times are over. So where do you think that these investors will put next? Will be where you should start thinking, if you are one of these investors that favors all these instruments. So this was already well predicted by the infamous Tom Lee, who is an incredible predictor. And he used to predict S&P 500 will hit 5,400. It came to pass. 5,600 came to pass. 5,700 came to pass. And the last one is 6,000 points, which we are now starting to wonder whether what he says will come true with a lot more belief. So the latest numbers that I just pulled out from the S&P 500 and the NASDAQ, and this is not even market close yet, is at 5,861. So it is not unthinkable, right, that the S&P 500 could potentially hit 6,000 points by end of this year, and the NASDAQ could maybe hit, 20,500 points or whatsoever. It's not unthinkable, not unthinkable. So basically what I'm saying is that those people who now realize that their returns from all these bonds and bills instrument is now not getting good returns, they now will to switch over to other instruments. Some of them, not all of them, some of them will decide that the stock market, which is on a fantastic bull run, could continue. I'm not saying it will, but I say these people could believe that continue. All we need is a fraction of them to continue, and they throw their money in the S&P 500 or the NASDAQ or equivalent, the whole stock market will continue to bull run. I've always said it again and again that the stock market over a long period of time, especially the S&P 500 and NASDAQ, will compound with a lot of volatility in between over a long period of time with a very, very powerful return rates. And last 2 years has been nothing short of a spectacular return. And right now, the good days for bonds is over. We certainly would like to see where the movement of money could flow to. And if they continue to flow a lot into the stock market, then the stock market will continue to rise and rise and rise. This phenomenon is probably only into developed markets. I couldn't say the same for the Chinese market. I certainly don't know how to predict the Singapore market, but I certainly would think that the US market will have some possibility of some upsides, right? So thanks for watching. Let me hear your view, and I'll see you in a day or two. Bye-bye.